Hey everyone, Couch Investor here, back to another video for today, and let's talk about the topic of the day. Lululemon down 9%, Macys down as well, Abercrombie up 9%. So what actually happened? Well, they all came out with an updated guidance. And to be honest, it can give us a better picture of how the economy right now is doing, what we can expect for the upcoming earnings report. Again, this week is also an important one. Jerome Powell is going to talk on Tuesday. CPI report, I believe, is on Thursday. So big week for the market. Don't expect anything crazy coming out of Jerome Powell's mouth. Probably will still reiterate that there will be no cuts in 2023. Let's see what happens with CPI report. If the downtrend continues, maybe he might change his tune. Maybe not in February, but probably the meeting after that. Let's wait and see. But first, let's talk about the retail numbers. And for that, we're going on Adobe Analytics. So total season revenue reached $211.7 billion this season. You can see revenue by day. Obviously, Black Friday, Cyber Monday are the peaks. Now, December 24th, so one day before Christmas, you can see it was the lowest point there. When it comes to discounts, we can see that the lowest point there for discounts in electronics was around 24%, toys 34%, apparel 15%. So it dropped obviously around that Black Friday, Cyber Monday weekend, and then it went back up. Now, to get a better sense of how much consumers were spending during the holiday season, we get a nice little comparison here. So in 2020, revenue was $188 billion, 2021, 205, and this year, 210, which represented a 2.5% growth. And so if we look at 2020, we saw a 32% year-over-year growth there. In 2021, 8.6% growth. So of course, this year, a 2.5% is on top of those 2 years. Now remember, last year, a lot of things were, well, just out of stock, not just for clothing, but electronics as well. Cars, we've talked about, well, the demand for cars, empty lots, etc. But right now, inventories are sky high. Most reports, as you will see in this video, most reports have mentioned that their inventories are extremely high. We've seen that with Nike as well. Although it has come down from the summer, it is still much higher than a year ago. We're going to read more into that later in this video. Now, if you're currently enjoying this type of video, leave it a thumbs up and subscribe if you have not. I would really appreciate that. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. And yes, I'm wearing this specially for this video. Alright, so now let's have a little comparison here between Lululemon and Abercrombie. So we can see Lululemon has revenues of $7.47 billion in the last 12 months, have been growing quite nicely each and every year. Abercrombie, $3.66 billion in the last 12 months, haven't really grown that much. Now, when it comes to free cash flow, Abercrombie is now negative $309 million. Lululemon trending down, is still positive, only $92 million in the last 12 months. When we look at return on equity, you'd love to see it. Lululemon at 41%, Abercrombie at 4.77%. Now, gross profit margin. These are not updated numbers. We're going to have a look at the updated ones in just a bit, but they're not far from that. And it's great to compare. As you can see, Abercrombie was much higher, has come down, is now closer to Lulu's. So 57.75 for Abercrombie and 56.25 for Lululemon. Still good gross profit margins, and those are especially in the last 12 months. Now, when we look at valuation, in this case, price to sales ratio in the next 12 months, Abercrombie extremely cheap at 0.4 times, Lulu 4.3 times. So let's have a look now at what actually happened. So at Abercrombie, the strong momentum we have seen all year at the Abercrombie & Fitch brand continued in the holiday season, with the women's business on track to deliver its highest four-quarter sales ever. Importantly, this strong performance has been complemented by an acceleration in men's growth from third-quarter trends. The market really appreciates that. For Hollister, a bit more negative here. While we expect to finish the fourth quarter with sales below 2021 levels, the sales trend improved nicely from the third quarter as we have begun to realize initial benefits from assortment adjustments and personnel changes. So, what were the changes for the fourth quarter? So the current fourth quarter outlook, they see net sales up in the range of 1 to 2%. Previously, that was down in the range of 2 to 4%. Operating margin in the range of 6 to 8%, previously between 5 and 7. And then for the full year, they see net sales down around 1%, previously down around 2 to 3%. And then operating margin in the range of 2.5 to 3%, previously 2 to 3%. So not really a big change there. Now, when it comes to inventories, this was the last quarter one. So inventories of $742 million, an increase of 36% to Q3 2021. Approximately 92% of inventory is current, defined as current season, long-lived, or future set. The third quarter lapped lowest Q3 on-hand inventory levels since the mid-2000s and the lowest total inventory in over a decade, driven by shipping delays and production shutdowns in Vietnam, where the company had outsized exposure relative to industry average. Low on-hand inventories in 2021 led to missed sales opportunities in the back half. And this is exactly what we can see and what we probably will see with a lot of other companies out there. Last year, the demand was sky high, so the prices could have been higher. And this is why margin have been higher as well. Right now, this is clearly not the case. Demand is down significantly. Inventories are up significantly. So what will happen? Margin compression, which is exactly what we are seeing here at Lululemon. So they now expect net revenue will be in the range of $2.66 billion to $2.7 billion, representing a 25 to 27% increase year over year. The previous guidance was $2.6 to $2.65 billion. So an increase in net sales from their outlook, which is fine. But earnings per share are now expected to be in the range of $4.22 to $4.27 compared to the previous $4.20 to $4.30. Not that a big change, but it is lower. Let's continue. The company also said it now expects gross margin for the fourth quarter of fiscal 2022 to decline 90 to 110 basis points compared to its previous expectations for an increase of 10 to 20 basis points. However, the company now expects that it will further leverage selling, general and administrative expenses 100 to 120 basis points compared to its previous expectations of 30 to 50 basis points of leverage. Okay, fine. Then a quick note from the CEO here. So he says, we are pleased with our continued revenue growth and momentum in the business as our teams navigate a dynamic macro backdrop. In Q4, traffic remains strong across both physical and digital channels, and we anticipate delivering another quarter of solid earnings growth consistent with our updated EPS forecast. 2022 has been a strong year for Lululemon, and we remain focused on the significant opportunities ahead as we continue to deliver on our Power of 3x2 growth plan. Again, let's see if we're out of the woods, if this is just a one-quarter problem or this is going to be the story for 2023, as inventories, again, are still sky high and demand is lower. Demand might become higher if suddenly interest rates are dropping or are not increasing anymore. Again, this is just speculation at this point, but right now the situation is not that great. And during the last quarter, if you look at inventories for Lululemon, they ended the third quarter with inventories that increased 85% to $1.7 billion compared to $0.9 billion at the end of the same quarter in 2021. And now the last company here is Macys. So net sales are now expected to be at the low end to midpoint of the previously issued range of $8.16 billion to $8.4 billion, while adjusted diluted earnings per share are now expected to be in the previously issued range of $1.47 to $1.67. Now they did say here that on a percentage basis, total of end quarter inventories are on track to be slightly below last year and down mid-teens relative to 2019. We're going to have a look in just a bit how much that was in the previous quarter. Now to reinforce the point I made earlier, they say here based on current macroeconomic indicators and our proprietary credit card data, we believe the consumer will continue to be pressured in 2023, particularly in the first half, and have planned inventory mix and depth of initial buys accordingly. Good. So for the numbers of last quarter, we can see here that, well, inventory turnover on a trailing 12-month basis was relatively flat to 2021 and improved 15% over 2019. More specifically, inventory was up 4% year over year and down 12% versus 2019. So to conclude, while this might be a little introduction of what we might expect in 2023, on the flip side, this might flip the Fed into, well, maybe not raising the interest over 5% this year. Let's wait and see what happens. Again, crucial week this week, and then meeting in February will probably shape 2023. But overall, what do you think about these reports? Let me know down in the comments below. Do you own any of these companies? Let me know as well in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.